Thank you. Good morning, students. How are you all doing? I'm sure it is a happy morning for everyone. A great morning for this topic. I'm sure by now you all are deep inside the concepts, the parameters, the nuances of various provisions of PGBP. And I'm sure today, when we deal with the detailings of the various provisions, you are ready with your queries, you are ready with your understandings, misunderstandings, right? Yes, that's great. So yes, very good morning, Ajay, Shamli, Mazia, Kuldeep, Ashlesha, Tisha, Deepak. Very good morning. Yes, Dhanalakshmi, Aditya, everyone. Very good morning to you all. So we are dealing with the computation of the business head income. Now, business head is something which is very vast, something which is very tricky, if I can say so, but at the same time, something which offers great insight not only about the business head, but about overall income tax law. So when you study this, you also develop an overall understanding of many other provisions of the income tax law. Now today, we'll be covering major module provisions so that what we have studied in my format will now be covered as per the law format. So as we have seen, the computation of PGBP income is done in the reconciliation format where your starting point is profit and loss account profit, that is simply profit as per accounting. Now, firstly, we are understanding the computation as per the new regime, which is the default regime. And then what is different between new and old, that you will get in the second working. So how do we start? We have to add those items, again recall the P&L. So we are taking this figure as our starting point. So how this figure is arrived at? It is arrived at by subtracting these and by adding these. So these are already added in the net profit. Keep this in mind mathematically. These are already subtracted in the net profit. Now, if anything from this side is not part of PGBP, it should be added back to nullify the effect of subtraction. And if anything from this side is not part of PGBP, it has to be subtracted to nullify the addition effect. This is the simple mathematical logic. Please read the statement carefully. It says expenses, most important, which is already debited to P&L, because we will find in the adjustments that there may be some expenses which are not debited in P&L. So for them, you will not add. So you have to first understand this particular point, which I have been explaining from day one, that we are taking this as our base, as our starting point. And this figure is made up of these items subtracted, these items added. Now, if anything which is already part of this P&L and not part of PGBP, what you are going to do is this. So what do you add back? Depreciation, which is part of P&L debit. Income tax, because we have seen that under section 40 clause A, income tax is disallowed. Then wherever you are making any expenses which is paid to residents and in India, on which either TDS is not deducted or after deduction is not deposited. Now, by when you have to deduct and by when you have to deposit, you should deduct any time during the previous year, that is up to 31st March 26, and by when you should deposit before the due date of filing returns. So in this case, if this is not done, any one of the things, and the payment is made to a resident and it is made in India, 30% of the expense will be disallowed. So that will be added. Similarly, wherever you are making payment to any of your related person, who may be your relatives, who may be your business associates, and the payment is unreasonable or excessive. Now, how do we decide unreasonable or excessive? Whatever is the fair value of that expense, your payment is exceeding that. In such a case, only the excess portion, only the extra portion will be added here. So only the excess above FME will be added. Next, disallowance which we have seen is again any expenditure for which you are making a payment to a person against a single bill in a day exceeding 10,000. No problem. You can make crores of rupees of payment in a day to a single person. The only requirement is it should be paid by account pay, check, draft, or using certain prescribed online electronic mediums. If you do that, fine. If not, then entire expenses paid is disallowed. This is important. So here 10,000 is the criteria. If the payment is 18,000, entire 18,000 will be disallowed. Similarly, certain expenses will be allowed to a mercantile assessee only if these are actually paid. Up to when? Up to the due date of filing returns under 139. Now, if these expenses which are listed in 43B are not paid, then they would be disallowed. Similarly, in same 43B, there is one special scenario where the payment is to be made to MSME. If it is paid beyond the time limit of the MSME Act, then again it will be disallowed. Further, personal expenses disallowed, capital expenses except few will be disallowed, repairs which is of capital nature will be disallowed. Now, preliminary expenses, we have seen that they are allowed 1/5. Now, 1/5 is allowed, but generally what is debited to the P&L is the entire preliminary expense. So if you can take deduction of 1/5, so the balance 4/5 has to be added back. Family planning expenses is allowed, but if the payer is person other than a company, then it will be fully disallowed. Then fine penalties, which are in the nature of offense, will be allowed, but fine and penalty, which is compensatory in nature, which is for some minor breaches of law, will be allowed. Next, expenses related to income, which is not taxable under this head. So expenses belonging to other heads, you have to disallow. Further, this point we have not discussed yet, so I'm not explaining this. This we will cover in the detailed provisions. Similarly, what you will subtract? You will subtract the credit side items of P&L, which are not part of PGBP. Along with that, you will subtract certain expenses, which are not debited in P&L, but PGBP allows you. So depreciation as per income tax provision will be subtracted. Now, interestingly, the 30% expense, which was disallowed in some past year because you had not deposited the TDS then, that 30% will be allowed in the current year in which you have deposited the TDS. So this 30% expenses of some earlier year and that year's TDS you have deposited in the current year. So it becomes deductible in the current year. Now, why this expense is deducted? Because in the current year, this expense is not part of P&L, but PGBP says we will allow it, so you deduct it. Similarly, those payments which are to be made as per 43B but not made in the earlier period, those were disallowed then. When they will be made in the current year, they will get allowed in the current year. Again, in P&L, since this is a past year expense, it is not debited, but PGBP is allowing you that deduction in the current year, hence you will subtract it. Similarly, those incomes which are credited to P&L but which belong to any other head. So a list of all those incomes are given. These are incomes belonging to other sources or of capital gain or of HP or of maybe salary. Similarly, you will add those incomes which are taxable under this head, but for some reason they are not credited to P&L. Like salary, remuneration, interest payable to a partner by the firm. So whatever partner is drawing from its partnership firm is part of his PGBP income. The only exception is share in profit, because share in profit is exempt in the hands of partner since the partnership firm has already paid tax on that. Similarly, what will be added? Bad debts, which are allowed as deduction under this, which is recovered. So this is the 41 item where earlier some bad debts were allowed as deduction. Now they are recovered. Similarly, in past period, there was some trading liability. Now that has ceased. So these are all items which will be added. Now, for the person who has opted out of the default scheme, that is, the person has gone to the old scheme, which is the optional scheme. Now, in such cases, besides the above adjustments, you have some more adjustments to be done. Now, these are those expenses which are not allowed as per the new scheme. So there are some expenses which the new scheme is not allowing, but these expenses were allowed in the old scheme. Now, when we'll study depreciation, you'll find that in depreciation, there are two types of depreciation. One is regular, one is additional. Regular is allowed in the new scheme, but additional is not allowed in the new scheme. However, old scheme allowed additional depreciation besides the regular depreciation. So this will be subtracted. So additional depreciation adjustment will be subtracted when you are doing computation of new scheme. Further, now see, this is a comparative list of expenses, whether they are allowed, not allowed in the new scheme, and whether they were allowed, not allowed in the old scheme. This will be a very handy uh, comparative point. So you should always make it a point that you will refer these pages whenever you want a quick summary of comparison between old and new scheme. So this is new scheme. This is the old scheme. Now what it says, allowability of deduction, treatment while computing income under their PGBP. If these are already debited to P&L, that one you do what you will do. Similarly, allowability under the old scheme and treatment under PGBP if these are already debited. Now see, this is important. If an item is already debited and it is also allowed in PGBP, what you will do, no adjustment is required. Why no adjustment is required? Because if something is already debited in PGBP, in PNL, and PGBP is also allowing it, then there is no need to do any adjustment. However, if it is given in additional information that is below the PNL and it is said that it is not debited in PNL for some reason, then mathematically what you have to do is you have to deduct it. So this is the reconciliation part. Now here, a comparison given as to what expenses are allowed under which scheme. So scientific research expense, revenue or capital, they are allowable both under the new and the old scheme. So there is no challenge with this. Then similarly, payment to outside approved scientific research association. Now importantly, what is important to note is under the new scheme, these payments which are made to outside scientific research associations, even though they are approved, but the new scheme is not allowing them. However, it was allowed in the old scheme. And then additional depreciation we have already seen. Plus, there is one more special point relating to Section 35 AD business that we will see as we proceed. Now, since this head deals with business head, or rather two sources of incomes are covered, business and profession. So what is business? Importantly, business means an activity which involves trading, which involves provision of service, which involves manufacturing, or any activity which is an adventure in the nature of trading, commerce, etc. Now, what is an adventure? Adventure means something which is done on a trial basis, which is one time, which may not be continued. So let us say you set up a, a cafe this year, but it gets closed down in a year or two. Still, in that year in which the cafe was running, you will consider it in PGBP only. It will not go to other sources. See why this clarification is important, because many times people say that PGBP will cover only those items which are done every year. That is logically correct. But you had the intention of doing it as a business, but it did not click, so you closed it down. Still, for whatever period you were running it, even though it is not carried on regularly, even though it was in the nature of an adventure, it will still be PGBP. Profession is not defined in the Income Tax Act. It only says profession includes vocation. So it does not actually define profession. But in general, profession means expertise work where you require some degree of learning or training. So it may be something like a professional course, what we all are pursuing, or it may be even certain skill sets. So what are those skill sets? Like a painter, a sculptor, maybe a dancer. They may not be taking any formal qualification, though nowadays even for art forms we have formal qualifications, but many of these may not be formal qualifications. Still, they are said to be carrying out profession. And then you ought to obviously have those professions where some qualification is required. Now, whether it is business or profession, both are covered under this head. Business necessarily means continuous exercise. So in general, business will mean a regular exercise. However, profit from a single venture, which I was explaining, which is in the nature of trade commerce, will also be treated as business. So what is important to understand is your intent. Some characteristics relating to PGP income are given. You may receive it in cash or kind. Capital receipts generally are not taxable under this head. However, you will find few exceptions where the capital receipt is also taxed under the business head. Interestingly, voluntary receipts. Now, what are voluntary receipts? Voluntary receipts are those receipts where you did not have any contract, where the person was not bound to pay that amount. However, the person paid that amount out of their own personal wish. Now, interestingly, the question is if this is done, whether it will be treated as a business receipt. So, for this, an example, an amount is paid to lawyer by a person who was not a client, but who has been benefited by the lawyer's professional service to another, would still be considered as your income. So, these are those indirect business receipts where you are getting something in addition to your business contracts, but if it has the character of business, it will still be taxed here. How you spend this money is immaterial. So whatever you are earning from business, there is no requirement it should be spent in business only. It can be spent for any purpose. So the source of earning decides the head, not how you are spending it. Importantly, if you are running different businesses, then for each business, you should make a separate computation. Later on, we will add all the different business incomes and subtract all the other business losses. But first, you have to do the computation separately for each business. Interesting point is legality. Now, many times a person is engaged in an activity which is his business, but that activity is something which is regarded as illegal. So let us say smuggling is illegal. Let us say betting gambling is illegal. But that person is into that activity as a profession. Now the question is whether it would be taxed. Now importantly, entire income tax law has nothing to do with the nature of income. So income tax is not restricted only where your activity is lawful. Even if your activity is unlawful and your revenue is arising out of some illegal source, still it will be taxed under the head business or under the respective head to which it belongs. Method of accounting, if you remember, we had discussed this. It says that in relation to PGBP and other sources, law gives you option that you may select any one of them, and whichever method you are employing in your accounting, we will employ it in your PGBP and other sources computation. However, some exception is created by 145B, where certain items will be taxed only on receipt basis. These you will study in other sources. So right now here, we do not have any such thing except one. So wherever you are granted subsidy by the government, so that subsidy will also be taxed only in the year in which it is received. So few incomes have an exception to the rule of option. Now, on similar lines to your accounting standards, we have ICDS in income tax. What is ICDS? ICDS is the income computation and disclosure standards. So on similar lines, how you have accounting standards, in income tax, we have these ICDS. Now, you are not required to study each of the ICDS in detail because that is not part of your inter-level syllabus. But since it is going to affect computation of PGBP income, so whatever provisions we are studying here, they are already incorporating the ICDS, like how in 11, 12 standards, you never studied the accounting standards in detail. But whatever accounting treatment you studied, that how depreciation will be dealt with, how reserves will be dealt with, all those accounting treatments were coming from the accounting standards only. But you were not taught the standard in detail, which you studied at a later stage, maybe at a professional stage. Same thing is here at intermediate state. We are not going to teach you the individual accounting standard in detail, but what you are going to study in the computation, that is already arriving from that accounting standard, whatever applies. Now comes the first section, which is your section which determines what incomes would be taxed under this head. So this is also your charging section of the PGBP head. So it gives you a list of around 25 plus items as to what would be taxed under this head. So first it says incomes arising from business and profession. Importantly, some capital receipts are covered. First capital receipt is if you are receiving any compensation, compensation relating to what? Compensation relating to termination of your management or of your office. And what was this management dealing with? Affairs of Indian company or affairs in India of any other company, so a foreign company. So let us say this is mainly, there was a period, if you know, where banks were earlier private, but later on they were nationalized. That is, the management was taken over by the government. Similarly, there was a period when airlines were also overtaken by the government. So wherever government overtakes the management of any business from you and pays you some compensation, that is PGBP income. If the assets are taken over and compensation is paid for that, that is part of capital gain. But only where management is taken over and what you are now controlling is now controlled by someone else, that will be under PGBP. Similarly, where you are having an agency and again that agency is terminated or the terms are modified and for this change you are given compensation, it is again part of PGBP. Similarly, where you had the rights of management of any property or business, and now that right has to be given to the government. So these are all different types of compensations which you receive for the loss of your right to run that business, right to manage that property. That is PGBP. Next, where there is any trade or professional body like our ICI, and it is rendering specific services to its members. So ICI conducts many programs for the members, many upgradations for the members, many activities for upscaling members. So for all these services where there is a specific P charge, that is to be treated as business income. Now, why this clarification is required? Because a trade association, or let us say a professional body like ICI or IMA or Bar Council, or even other such trade or professional associations, they are generally formed as a not-for-profit association. And when they are performing any such activity, their intent is never to earn profit or do it as a business. But under income tax, as we studied above, we are not concerned with your intent or purpose. If you are earning income, until unless it is made specifically exempt, you have to pay tax. Now, if this income is not made exempt and tax is payable, then the question will come which head. So they have clarified we will tax it under the head business only. So this section 28 makes a specific requirement as to what would be taxed under this head. Similarly, where you are receiving any incentives from the government. Now, many times this is relating to export. So what types of incentives you are getting? You are earning profit on sale of some import license, or some cash assistance is given by the government. Some duty drawback or refund is given by the government. So these are those different schemes where because of your export, some export related benefit subsidy incentive was given, which is taxed under this head. Now, this is an interesting point. When you receive any benefit or any perquisite, so perquisite is like additional benefit, and this is arising from your business or profession, whether it is received in money form or not. So it may be received in kind. Many times you get facilities, many times you get some lavish uh, tour package because you are agent, holding agency of some uh, branded company, and because you have met targets, you are given such tours, you are given some bullet vehicle or some SUV car as an incentive, as a perquisite. It will be taxed under the head PGBP. This point we discussed above. As a partner, whatever you will receive from your firm, which may be in the form of interest on capital, salary, bonus, commission, remuneration for your work, all these things will not fall under salary head or other sources head. They will fall under this head only. Now, there will be some calculation. There is some limit which we are going to study in section 40 clause B. Up to that limit, whatever amount is received by you, that will be taxed under this head. If you are receiving any amount above that limit, that is not taxed under this head because that amount is also disallowed to the firm. So what is allowed to the firm as expense is what is taxed to you under this head. What is important is the firm is also giving you share in profit. Just recall your partnership accounts. So you receive interest, you receive salary remuneration, you receive share in profit. Share in profit is exempt in the hands of partner because firm would have paid tax as their PGBP income. So in our hands, it is exempt. This is the point. Next. This is what is non-compete fees. Now, after the new Competition Act, you are allowed to legally enter into an agreement whereby you agree not to carry out any activity of business or profession. So let us say I'm starting a cafe in a particular area where there is some established big cafe or a big restaurant. They ask me not to run cafe over there, at least in their area. They are not restricting me to not carry it at all, because in that case, it would be agreement in restraint of trade and it would be ultra vires. It would be an invalid contract. But only when they are restricting me for a particular time period, for a particular place, that is now what is allowed by the Competition Act. And for that, they are paying me a compensation. This will be taxed under the head PGBP. Fine. Now this is important point, but for that, just allow me 2 minutes. Now, Keyman insurance. Now let us have some discussion on that, students, because this particular item has different applications. I'm sure you would have studied this earlier also. Try to recall where you studied and what you studied. So firstly, what is a Keyman insurance? So it is a life insurance policy, but it is not a regular life insurance like how you and me are taking. So this is a special life insurance policy specially created for businesses. Now, where a business feels that any employee or any director or any partner is a key person to that business. That person's life is critical to that business. And if something happens to that person, the business may come to a standstill, the business may have to be closed down, or there would be huge losses because that person is such an important person to that business. Then the insurance companies have crafted a special insurance policy where the owner or the employer is paying the premium for the life of the employee, director, partner. So here what is special? Like in our insurance policy, we are paying our own premium. Here, the premium is paid by the business. So if I'm paying for my employee, so I'm paying as an employer. If I'm paying for my director, I'm paying as a company. If I'm paying for my partner, I'm paying as a firm. So I get deduction under PGBP that will study in section 37(1) for this insurance premium, provided this life insurance is a Keyman insurance. So if I have taken a Keyman life insurance, then the premium which I'm paying for the life of somebody else, like my partners or my directors, etc., who are key person, I will get deduction under PGBP. Now this is about the expense side. Now we are on the income side. Now, if something really happens to any of these persons, then whatever policy amount I will get, Now, this Keyman insurance in the insurance policy provides that either the payment will be given to the business, that is to the employer who has paid insurance, or it will be given to the person, that is the employee or director, or after their death to their family members. Now, this is where the income side comes. Now, firstly, when I paid the premium of this insurance, I got deduction under my PGBP that we will study in 37.1, though we had discussed this in the previous class also, but section wise we'll study in 37.1. Right now we are discussing on the income side where I receive the policy amount. If as a business I receive it, business means as an employer, as a company I receive it because of the death of my employee, director, etc. For me, it is taxable under section 28, that is this point, that is PGBP head. If employee receives it, it is taxable as profits in lieu of salary under section 17 bracket 3 under the head salary. This is what I was asking, that whether you have studied this. So this is where you would have studied this earlier in salary chapter. Okay, Arun is asking, nahi, Arzu is asking, sir, what is duty drawback? See, you pay customs duty at the time of import, and at the time of export, that duty is given back to you because you have exported the same goods. So getting back what is paid by you is drawback, like a refund. Fine, Arzu? Okay. So coming back to this point, so where as a business, I get the policy amount, it is taxed to me under section 28. If the employee gets the policy amount, it will be taxed as their salary income called as profits in lieu of salary. If the director will get as a director, then it will be taxed under other sources. Or if the family members of these persons will get this policy amount, it will again be taxed as an income from other sources. So this Keyman insurance policy amount is taxed under three different heads depending upon who receives that amount. Students, is this clear? Because this is something important. This is something which is covered in different heads. And many times in your MCQ questions, where you are having case study, this point is important because that is where they ask you as to taxable under which head. That depends upon who is receiving it. Fine. So I've been talking for around 40 minutes. Let me get some inputs from you because today it is more of theory, theory, theory. It is one side talking. So shall I give you all 2 minutes? Anybody wants to ask a query, anybody wants to say anything, even if you want to just say hi, hello, fine. Just to break this monotonity. Chalo, if anybody wants to unmute and say something, fine. Chalo. Yes. Anything other than even PGBP is fine with me. I just want to break this monotonity. Tell me, any questions, any doubts, any issues in studies, any other general point? No problem, Mustafa. Equally thrilling morning to you. Yes, Prerna. Good morning. Yes. Students, give me some response in any form. Hi, hello, greetings. Huh. Mustafa, I don't know whether it is easy or not, but it is really interesting. The subject of taxation is very interesting, especially income tax. Okay, Shamli has a question. Sir, public donation to charitable institutions comes under CSR, so disallowed. See, CSR will not include any donation because for CSR, there are some specific requirements under the Companies Act. Because the CSR, when you say it is exclusively as per the specific provisions of Companies Act. So any donation or donation to any charitable institution will not fall under CSR. First point. Second point, whether it will be allowed under PGP, the answer is very clear, no, because whoever to whom you have made the donation, it is not a business expense until unless it is a specific donation under 35, it will not be allowed. Kuldeep is asking, Keyman received by employee salary, correct? Received by directors, but which directors? Who are not full-time employees. Then other sources, if directors are full-time employees, then again salary. Received by employer, PGBP, correct. And one more thing in this, Kuldeep, if it is received by family members of these employees, directors who have passed away and because of which this insurance policy has become due, then again it will be other sources. So where it is received by the family members also, it will be other sources, right? Okay, Arzu has raised hand. Yes, but Arzu, tell me.
Sir, I have a query regarding. I am audible?
You are clearly audible, beta. Tell me.
Yes, sir. The Shivam Wala.
कौन सा वाला बेटा?
Shivam. Question number
शिवम,
7. हाँ,
ये वाला 7. Arzu, what did you ask? I didn't get. Arzu, your voice is not audible now.
now audible, sir.
Audible, beta. Tell me.
Sir, the treatment of opening stock and closing stock
Beta,
because
1 second, 1 second. You are asking question from the practical part.
yes, sir, yes.
वेट मैं आता हूँ प्रैक्टिकल पे. अभी बीच में प्रैक्टिकल मत लाओ एक बार.
अच्छा,
हाँ, थोड़ा सा नहीं तो ट्रैक चेंज हो जाएगा. जस्ट गिव मी सम टाइम. After the break, I'll take the queries on practical also. Right?
oh, yes.
Yeah. Yes. Aditya is asking, sir, how to remember PGBP pro forma? Aditya, I strongly recommend not to learn the pro forma. Right from day one, I'm giving you that P&L diagrammatic pictorial logic. Today also I started with that. Debit is what is subtracted in net profit, credit is what is added. Aditya, you have to go by logic. You can learn, but then learning is rectifying. Anyways, for me, rectifying is many times difficult. I have done that only very exclusively for those concepts which are totally out of my mind, but only for the purpose of exams I did. But for PGBP Proforma, I will not recommend rectifying because you cannot learn the Proforma. It is a simple maths. So if you understand the logic and then somewhat learn, it is okay. But firstly, I believe strongly learning is not required. You need to simply understand that whether this item is part of PGBP head or not. If not, but still part of P&L, then you have to add or less. And I have been already explaining that right from day one, the PGBP format logic. Please follow that logic, beta. Anil is asking, Keyman insurance policy expense deduction will be under PGBP. Correct. And income chargeability will depend upon who received it. Exactly. You're right, beta Anil. Yes, hi Nikhil. Yes, Divya, good morning. Ishwarya is asking, I read this chapter from module before with comparing to your notes. I feel difficult to compare those notes with module as it is completely different from your notes. And I feel like this is very tough to handle. What I suggest is, can you help me to find the easy way to understand the module? I think, beta, today after going through the module, I think this problem should get solved. See, I repeat, my notes, beta, I had said on the first day will help you to practically solve the questions, which is the utmost requirement when you deal with exams and even in your practice where you're doing computation. But when you go to module, it is in the sequence of act. Please understand, beta, don't compare both things because both are from different approach. Module is from the law approach, that is when you are understanding the law. My notes are very specifically from your exam approach or from the practical approach which you'll require whenever in your career, in your office, you are using the PGBP computation. So both things you cannot merge. Right now today, why we are discussing the whole module so that you get the feel of the law also. This is how the law sequence is. So law sequence is in a different logic. My notes are derived on different logic issue. Yes, Tanisha, but that's great. So you'll understand the logics better. See, you have to be patient with subjects and especially topics like PGBP, topics like capital gain, TDS, deduction, because these are very vast. And many times you require a specific approach, like how we did not go by this theory approach. For first two lectures, I exclusively went through the practical approach so that understanding and also application for exams becomes easy. But still, it is always, remember one thing, students. I know studying may be boring, studying may be tedious, but we are in profession. And as we saw the definition, it is an expertise field. And for expertization, two things are required: deep, continuous learning and continuous practice and training. There is no exception to both these things, and both will require hard work, both will require consistent efforts. So I can understand watching some series on Netflix may be very entertaining, or you can even binge watch for 2 continuous days without even taking a nap. But that will not be with studies. For studies, you will have to apply yourself. But that is how everything is better. It is not that anything will come easy. In fact, I believe if you are getting something easy, you should be more cautious because things which are coming to you without efforts may not last. So those things which you earn means not like income, but something like qualification, like knowledge, like expertise, is what is going to be long term and what is going to be with you always. Something which has come without much efforts will never be what you can say long term, and you cannot depend on that. So efforts required. It may be boring, it may be difficult, it may be at times frustrating, but that is how any professional is created from any field. You go to Bollywood, you go to cricket, you come to our profession, any field, nobody has got anything easy. It has taken them. Let us say we see a star in a movie and we say, wow, what a star. And we start liking that person. But behind that, there is great effort. Firstly, in maintaining themselves. Secondly, see, you enjoy a movie, you enjoy a dialogue, you enjoy a particular scene. But for shooting a 2 minute scene, that person may have given 100 retakes. And after completing that, at the time of dubbing, he has to repeat the same thing, the same emotion he has to bring in his dialogues. So it is not an easy job. We see the final edited product of 2.5 hours. But behind that, the efforts is tremendous. So just think you are enjoying a movie, but it is so boring for the actor, actress to repeat the same thing. It is so frustrating for the director to keep on asking them doing the same thing again and again till the perfection is reached. So Nowhere things are easy, beta. And that is where you shine out. That is where you stand out. So keep this in mind. Good question. How to maintain discipline? See, um, this is something which is asked, rather not asked by people. People only say that you should be disciplined, you should be focused, but nobody tells you how. I believe there are two, three stages. And I think what is missing with you all is the very first stage. What is that first stage? Before you get the answer of how to maintain discipline, how to be focused, how to be consistent, the first thing that you should ask, why? I'm sure those who are finding things very troubling, very boring, very easily you get diverted, very easily your focus is disturbed, distracted, is because you don't have that why. So, Arzu, thank you for asking this question because in any field, again, now I'm not only talking about studies or profession. I've given you example of Bollywood. Go to cricket. We see our best favorite cricketers, which may be MS Dhoni, Virat Kohli, Sachin Tendulkar, or today's newcomers. But to reach that level where in a split second, when the bowler has released the ball and it reaches you, which may be even before the second clicks, you have to take a call how to play that ball, whether to hit it in the air, whether to hit it down, or whether to leave it. That split second thought and then executing your thought requires tremendous back end hard work. So, from where does this focused, consistent, hard work, disciplined work comes? The answer is when you get the answer to why you want to do anything. What is the goal of your life? I think we have never thought on that. When I meet students in different conferences, or if let us say I'm traveling somewhere because I regularly travel for my work, for my sessions. And over there, when I meet students who come and meet me personally, I always ask this question, what is the goal of your life? And strangely, I get the answer, sir, becoming a CA, becoming a doctor, becoming a lawyer. I don't think these are goals. These are steps to reach your goal, to achieve your dream. The problem is we have not even dreamt properly. You don't have a strong dream. So you will get discipline, you will get focus, you will get the fighting strength, you will get um, what is always a problem for you, not being able to sit for long hours, not being able to handle the pressure. All these things you will get if you get this first stage answer. What is your dream? Why you want to do anything? Find answer for that, beta. Mustafa asking how to solve RTP, MTP, PYQs in taxation, finance act changes, and all other rates are changes. Mustafa, beta, it means you have not visited our BOS portal. Let me tell you, we at BOS are taking such hard efforts whereby we are continuously updating things. Yes, this is a challenge, but more challenge than you, it is a challenge for us because you are studying something once, like you all are studying the latest Finance Act. You are only studying for your exams, but for us, it is a even bigger challenge. Like for me, I'm teaching two different Finance Acts in a day to one batch who is in the revision. I'm teaching the old Finance Act. To y'all who are going to give exam next year, I have to teach the new Finance Act. Now, before your batch concludes, we'll have the next Finance Act 26 on 1st Feb. In fact, we are even preparing for that backend because what would be the changes? What would be the new provisions? So at a given point of time, we are handling multiple things. But answering your question, Beda, we are updating our past material for tax. So as far as tax is concerned, you just have to follow the latest material which we are regularly uploading. And in case you are taking any past material, see, fortunately in past finance act and the current finance act, there is not a very big difference. So as a professional student, but I'll suggest now that if you have already studied the past finance act, which is 24, and you want to go to changes for 25, simply take the finance act. You can download it easily from Google. Download it. You will find that there are not major changes. So that much better anyways in profession you'll have to do. But still, we have taken all the efforts. Just refer to the latest material, right? On the BOS portal. See, for September 26 also, better you can say this batch is applicable for the reason the budget will be announced or will be tabled on 1st Feb. But generally, the provisions, or if I am talking about income tax, will be effective maybe somewhere from May, June after that budget is passed. And for us, provisions in last 6 months are applicable. So even Ishwarya, you can say majorly this batch will be applicable even for September 26, right? So, Beta Mustafa, if this is your first time to study, then simply take the latest material. Na? We have already put latest things. So only refer the latest material. Yes, Nagaraja.
Sir, my voice audible?
You are clearly audible. Please tell me.
Sir, day by reading the income tax law, come to my mind the creation of one thought, sir.
Hmm.
Uh, Income tax law, like a compared to construction of building,
Hmm.
because of its constructed step by step basic concept from the foundation to heads of income or pillars.
Correct.
Competition based as floor, so it is deduction or the finishing work, and the final tax liability is the roof. All the part must be applied in the proper sequence to complete the structure.
Correct. Right, Beta. True. Great. So let us proceed, students. Now, again, these 2 points are very interesting. This again, I'll be dealing later when we go to that section. But what is this point? Now, let us say you are holding some land and building or land or building in your books as stock in trade. What is this stock in trade? Stock in trade means you are a dealer in land. So you are a property dealer. You have purchased some different plots in different areas, and that is your business. Or let us say you are a builder developer who has constructed building and selling the shops or flats or offices in that building. Now, in this particular case, for you, the land building is stock in trade. Now, let us take a simple example of a builder. You have constructed a building which has around 100 shops and offices. And this is your stock in trade, all those 100 shops and offices. Now, after 2 years, you find that there is the first floor, which is still vacant because you are not having any buyers. And you also decide to have your own office over there. So what you decide is now in this entire building, the first floor, you will take over and make your own corporate office of your business. Now, the moment you do this, this stock in trade or this particular shop or flat, which was shown in your balance sheet as stock in trade, will now become your capital asset. Why capital asset? For the simple reason, because now it has become an asset which will be used in your business and which is not now held by you like a product or goods which you want to sell. So earlier, these offices were held by you like a commodity in which you were trading, in which you were dealing. But now you have changed it to an asset which you will be using in your business. Now, this is the case which is called as conversion of stock in trade into capital asset, right? Now the point is, pay attention. Earlier, there was nothing mentioned in law for this. But now they say, if you are changing some item which is stock in trade to an asset, so in balance sheet, what is happening now? See, this is balance sheet. Again, today we have a vertical format, but again, we all have been taught balance sheet in our childhood days in this horizontal format. So that is always convenient and it is pictorially very comfortable. So here you have fixed assets where you show your land, building, plant, machinery. And in current assets, you show inventory, debtors, etc. Now this shop was appearing here as your inventory, as your stock in trade. Now, up till this year, that is up to the last balance sheet. Now in the current balance sheet, you have shifted it here. And this you will do in accounts because for this obvious reason, the obvious reason is that there is a change in your classification because now that shop will not be held for sale. It is now going to be your own business asset. This is what is called as conversion of stock in trade into capital asset. Now, interestingly, the law says henceforth, this will become a capital asset for you. And in future, after 8, 10, 12, 15 years, whenever you decide to sell it, it will be going in the capital gain chapter because now it is your capital asset. But today or until today, it was stock in trade. So when you have shifted it from stock in trade to capital asset, let me treat this as a PGBP income. So this is something interesting. We call this as conversion of stock in trade to capital asset. This is treated as a PGBP income. Now the question is, you have not sold it to any outsider. There is no money coming to you physically, but we still want to tax it in the business head. So the question will come, what will be the amount that will be treated as the sale price? So section 28 has said, whatever is the fair market value of this asset on the date on which you have converted it into a capital asset, that fair market value will be treated as a business income or will be treated as the sale price, and you will compute your PGBP income taking this amount as the sale price. So this is what is a special point, students, which you should keep in mind. Again, very important for the MCQ type of questions. So in this section 28 list, I have kept two things pending because they are connected with some other section. This is one, section 35 AD item. And one more item somewhere I had kept. Some one more point I have kept because that is connected with a future part that we will discuss. So when that section will be covered, we'll cover that part. Now coming to another very important concept, that is speculation business. What is speculation business? Whenever we hear this word speculation, we have visualization of different uh, activities. Let us one is betting, gambling. So somebody is playing some online game or going to some casino and playing something. Over there, what you do is you speculate. That is not covered here because for that you have a specified other sources. Then the second thing that comes to everybody's mind when you hear speculation is share market. Now, please let me tell you, students, even though a common man may call share market as speculation, a common man may assume share market to be a speculative business, law has not considered it a speculation. Firstly, whatever trading you are doing in stock market, where it will come either in capital gain chapter or PGBP chapter. depending upon where have you classified those shares in your books. If those shares are held as a capital asset in your investments, in the balance sheet in investments, then whenever you sell those shares or any of your financial assets, it will be capital gain. But if let us say you are in the business of share trading, today this has come up as a very common business activity. In fact, if you go to YouTube and other online platforms, you will find that many people are even training you how to do stock trading, because this was there since past many years. This got a boost when technology came in, when you could now do the trading online, but it got a bigger boost during the COVID period, because that was the time when people really were idle and they got time to look at something which they can do from home. And now share trading is a regular activity where people are on a very focused basis, on a very intentful basis, doing regular trading. Now, where you are in the business of share trading, that is covered in PGBP. But interestingly, in PGBP, we are not treating entire share market or entire share trading or entire these items of share market trading as speculation. In fact, majority of this trading is your regular business. Only some specific items are speculative business. So let me clarify this. Any shares, debentures, or any financial asset sold by you, firstly, maybe capital gain if it is held by you as an asset, or it may be PGBP if you are doing it as a business on an intentful basis. But within business head also, it will be regular business. Only in some specific set of conditions, it will be a speculative business. Now, why you need to segregate the business into regular business and speculative business? Because when we proceed with income tax law, you will find that there is a topic of set off and carry forward of loss. Over there, there is a very different treatment to the set off and carry forward of losses which are arising from speculation business. So there are a lot of restrictions. Hence, it is important to categorize that whether your business is a regular business or a speculative business. So as you can see, for loss arising from speculation business, there are lot many restrictions. Hence, we need to compute this separately, distinctly, and it has been treated as a distinct business. Now coming to what is speculative business. Please pay attention, because as I said, 90% plus people are assuming that stock market is speculation. Sorry. In fact, today, after the use of so many apps and technology, software and technology has made predictions more structured. I cannot say precise because ultimately they are predictions, but more structured, and people are engaging into this activity like any other business. See, every business has some risk, every business has some speculation. Simply because you are doing in stock market does not make it speculative. Then what exactly is speculation? Firstly, let me clear this. It may be dealing with stock market, it may not be dealing with stock market. This is important. So speculative transaction may cover stocks, that is shares, debentures, and it may cover any other item also. And it may be done in stock market or it may be done in any other marketplace. So what is this speculative transaction? So it is a contract of purchase sale. Of what? Of any commodity, which may include shares, but it is not only shares. So firstly, what is a speculative transaction? It is a contract of purchase and sale, like any other business contract. But then what is so special? What makes this purchase sale a speculation? The interesting part is where this purchase sale transaction is happening and it is periodically settled. How? Without actual delivery, without actual transfer. This is what is speculation. Now you'll say, sir, what is this? I did not understand. So I'll give you a simple example. Now, first, the example which I'm giving you is of stock market. And let me clarify, today, this transaction in stock market is now regarded as a regular business because of that specific definition. But earlier, this was in the speculation category a few years back, and this is the best example. So in stock market, you have a derivative segment. I don't know whether how many of you know this. So there is a normal stock market segment and there is a derivative segment. What do you do in the derivative segment? So let us say in the normal stock market segment, what we all see that this share price has gone up. So let us say Indigo shares strangely are still rising. So I want to trade in Indigo shares. Now, one is I can go to the regular market or the regular segment of stock market and purchase the physical shares. Or I can come to the derivative segment of the stock market and instead of purchasing the physical shares, I can only book a entry in my name. So I will say book 1000 Indigo shares in my name. Today, let us say the price is 2200 per share. So I will say book this in my name. I'm using the word book. So you can just visualize there is a debit entry in my name. And let us say immediately after 2 days, I say that, okay, now show this as a sale and the price is increased by 25 per share. So by this purchase and sale, I have earned 25 into 1000, 25,000 rupees. This transaction is what is a purchase sale transaction of any commodity. Right now it is example of shares, which is settled without actual delivery or actual transfer of these shares. I neither actually purchased them, neither I actually sold them. It is done only by a debit credit entry. In your FM subject at the final level, you will study these concepts in more detail. Now, let me tell you first thing, there is nothing illegal in such type of transactions. In fact, in businesses, many times such contracts are entered into for various purposes of business, not for earning income, but for protecting the business from any unexpected rise or fall in prices in future. That is where such contracts were originally used to protect the business, which is called as hedging. Now, the interesting point is where you are engaged in any such contracts or transfers, where without physically taking or giving the commodity, the item, whatever you are dealing in, your account is periodically settled. Settled is purchase, sale, debit, credit, settled. This is what is speculation. So where purchase sale is happening without actually giving or taking the delivery. That is what is speculation. Point number one. Point number two. What is speculation? Now, in the second part of this definition, they have covered a specific scenario which is applicable only to companies. So you are a company and you are not engaged in banking. You are not engaged in investment business. So let us say you are a manufacturing company. You are, let us say, MRF tires company. Now you are purchasing and selling shares of some other company. And this is a regular purchase sale, physical, not the above one. If it is above one, anyways, it is speculation. Now we are in the second part where a company which is not in the business of trading of shares, which is not a banking company or any such investment company, because for them, there is a compulsion under various laws, under RBI norms, that they have to compulsorily keep themselves invested in certain securities. So where purchasing, selling security is not part of their business, but still they have entered into some purchase or sale of shares, obviously of other companies. Then this company, in my example MRF, will be deemed to be carrying on the speculation business to the extent of such purchase sale of shares. So in short, a company whose business does not includes investment business or banking business, if they are dealing in shares of other companies, to that extent they will be deemed to be doing speculation business. So which companies are excluded from the above second part of definition? The one whose business includes purchase sale of shares. Why? Because they are investment companies, or their principal business is business of trading in shares, or they are banking companies, or they are in the business of granting loans, because for them there is a compulsion to keep some amount invested in certain securities. So for these companies, if they are buying selling shares, that is not treated as speculation, that will be part of regular. But for other companies, like I gave example of a manufacturing company, or let us say some software company like Zoho is trading in some other company's shares, in that case again it will be treated as speculation. Now, what is not to be treated as speculation? Now, this is exception to the first part. As I said, all these contracts of settling the accounts without actual purchase, sale, or actual delivery is part of business for what? For hedging, that is protecting their business from any future price rise or from any future change in foreign currency rates. You know that foreign currency rates are fluctuating. Right now, dollar is at a all-time high as compared to Indian rupee. So I'm a person dealing in foreign trade. I know I have to make payment in foreign currency or receive payment in foreign currency, but that will happen after 1 month, 2 months. And at that time, if the foreign currency rate fluctuates, I may incur a loss. So to protect myself, I enter into such forward contracts, such hedging contracts, where I enter into a contract of purchase sale of these foreign exchange to protect the fluctuation. So where I'm doing any such type of hedging contracts for my business, for raw material, or for any stock or shares, or I'm entering into forward contracts, all these are excluded from speculative business. In all these contracts, the same thing is happening, that is purchase sale without actually delivering the item. Then, as I said, the derivative segment of stock market, which was earlier in speculation, has now been removed from speculation, provided you are doing it through a SEBI registered broker. In that case, if you are carrying out this derivative transaction in a recognized stock exchange, it will not be considered as speculation. Similar to derivative, there is another segment called as commodity segment. Again, that has been excluded from speculation. So in fact, today, a major part of stock market is now excluded from speculation. It has now been treated as regular business. Fine, students, let us take break. We will take a break of around 15 minutes. And after that, we will proceed with some more provisions. Today, I'll try to cover majority of the small sections of your PGBP head. Majority we have discussed already when we were doing our computation and all. But today we will look at them in more detail. Fine. So 15 minutes break. Now 28 covers what incomes would be taxed. 30 onwards covers what expenses would be allowed and what are the restrictions. But this 29 is a very interesting section. It covers neither incomes nor expenses. It simply gives you a direction. So it simply says that whenever you are computing the PGBP income, you have to apply and utilize the provisions which are contained in 30 to 43D for doing this computation. So basically it is like a guiding section saying that you follow 30 to 43D, where 30 to 37 deals with expenses for which deductions are allowed, and thereafter there are some restrictions where deductions will not be allowed. Now, starting with the deductions, first is section 30 and the next section 31. Both deals with similar thing. Now what both deals with? It deals with expenses related to your assets except depreciation. Because for depreciation we have section 32. So what are the expenses related to asset except depreciation? It may be rent rates, taxes. So like for building you have the property tax, or it may be the repairs or insurance. Now 30 covers expenses on building and 31 cover expenses on the other assets like your machinery, plant, furniture, same, repairs, insurance. So the condition which are put in 30 and 31 are those four basic conditions which we have been discussing, our four golden rules. So the requirement is that firstly, the expenses should be for the purpose of business. So what are the four golden rules? Related to business, current year, revenue, not an offense. So you should be occupying it for the purpose of your business. If you are not occupying it for business, you are occupying it for any other purpose, the deduction will not be allowed. Now, deduction will be allowed for rent if you are a tenant. Deduction will be allowed for repairs. This will be allowed to both owner of building also, and even where you have taken the building as a tenant. In either case, you can take deduction of repairs. Now, importantly, our golden rule, if you have incurred any repairs which is of capital nature, that will not be allowed. So capital repairs cannot be claimed as deduction. Only revenue repairs can be claimed as deduction. Further, other expenses like expenses by way of land revenue, local rate, municipal taxes, all these will be allowed as deduction. Again, subject to the condition, the building is for the purpose of business or profession. Now, where you are using the building partly for business and partly, let us say, for your personal use. So many times, like in case of professionals, we have a flat in which the backside part of the flat, the kitchen, bedroom, we are using for our residence, and the front side, which is the hall or some lobby, we are using it for our business. So where you are using part of the building for business, then you have to proportionate the expense. How to proportionate, that is provided in section 38, which is simply on area basis, and only part expenses which are related to business will be allowed. So again, following the golden rules related to business, most important. Similarly, for other assets, the repairs insurance, again, they follow the same rules. So firstly, it should be for the purpose of business. Then repairs will exclude capital expenses like expenses on replacement, reconstruction. Since these are capital, they will be excluded. Only the revenue repairs will be allowed as deduction. Now in repairs, there is a very interesting point in both 30 and 31. There is something called as current repairs and there is something called as accumulated repairs. What is current repairs? What is accumulated repairs? So accumulated repairs and current repairs is, let us say this year a crack developed in your building, in your wall, in your tiles, and you immediately did some fixing up. You filled in some cement or you applied some lotion and you filled in the gap. This is current repairs. But let us say this crack was not taken care of and it started adding up. So because the crack was not filled in, proper care was not taken, the crack started expanding. And let us say after 4 or 5 years, of this regular wear and tear and the crack being not attended to, the entire wall collapsed. So you had to redo the wall, you have to change the entire tiles. Now, such repairs are called as accumulated repairs or arrears of repairs. Now, interestingly, section 30 and 31, both which allows repairs to the owner, they allow only current repairs deduction to the owner. But if it is an accumulated repairs, and most important, if it is not a capital repair, it will be allowed to the owner, but not under section 30 and 31, but you can still claim it under 37(1). So for owners, both section 30 and 31 allows only current repair under this section. Accumulated repairs or arrears of repairs are allowed in 37(1), both with the same criterion. It should not be capital in nature. But for a tenant, if you are a tenant, both current and capital repairs are allowed in this section only. So interestingly, only the section is changing, but this will be relevant for you for the MCQ type of questions. So again, this point we have discussed, capital nature will not be allowed. Then comes a very important section. Now today I'll be first going through the theory part of this. The practical part we'll do separately in the next class. Now for depreciation, we have section 32 read with rule 5. Now today we are doing the theory part so that depreciation is done twice. So it will be more consolidated because it is a very important section. Now, if you remember in one of our previous session when we were doing practical sums, this was one of the questions, that is it compulsory for you to take depreciation? Now you'll say, sir, what type of question is this, or why this provision had to be put in the law? Please understand, depreciation is not a real expense. You're not spending something out of your pocket. It is a notional expense. It is an expense which is presumed. Depreciation is at some rate. So you are taking depreciation at 10%, 15%, 20%, means on an assumption basis. Now it is very possible that in a year you are not debiting depreciation. Now, why you will do that? Answer is simple. I'm not having sufficient profits in that year. So I want to use this depreciation in future years when I get huge amount of profit. So such type of planning is not possible because this explanation which was added later on, not at the time when the section was created, but it was added later on, that now the law has made it compulsory for you to claim depreciation. So whether or not you are showing it in books in your account, that is your choice. But for the purpose of PGBP, every year, whatever is the depreciation as per the rule has to be compulsorily debited, has to be compulsorily charged against your PGBP income. Now, this rule is very important. Along with the act, you also study parallelly rules. So Income Tax Act section 32 and Income Tax Rules rule 5. They deals with depreciation. Now, combined reading of both these has led to the following provisions. Now, there are some conditions, there are some provisions made. First is, for the purpose of depreciation, the rule has divided the assets into two categories. One is tangible and the other is intangible. So intangible, you have building, machinery, plant, furniture. Please mark, land is not there because we have studied in accounts also that depreciation on land is not allowed because land is not a destructible asset. So same principle is followed here. You don't have land in the depreciation category. And in intangible, you have then all types of rights like know-how, patent, copyright, trademark. So we call them as IPR, intellectual property rights. Depreciation in the value of any capital asset cannot be claimed as deduction from the business income. Now this is interesting. So you cannot claim depreciation of any asset other than the above. In short, only those assets which are covered in the above list, they are eligible for depreciation. So maybe in accounts you have created some more assets, like let us say you have investments, you have debtors, there are so many other assets, but all assets are not depreciable asset. You will not be allowed depreciation. So any other capital asset, no depreciation. Similarly, no depreciation for land. Correct. Next interesting point. You have depreciation for plant. But in income tax, plant is very specifically defined. Now you will be slightly amazed to see what does the income tax law include in plant. It says plant includes even ships, even books, even your vehicles, even a scientific apparatus which you may have brought for some research and such purposes, even surgical equipments. So, besides the normal meaning of plant, in income tax, for the purpose of depreciation, plant will include all these things, but it will not include tea bushes, livestock, etc. Please mark this again for the MCQ type of question. Most important part, plant does not include animal, human body, or stock in trade. Now, there was a very interesting judgment why this point had come up. A very famous lawyer, Mr. Prashant Bhushan, or maybe Mr. Shanti Bhushan, I'm mixing in the name, who is a very renowned lawyer of Supreme Court, had heart attack and he underwent some surgery and huge expenses were incurred. He tried to claim deduction of those expenses, treating the heart as plant, saying that it is a very important asset for his profession because without a good heart, he will not be able to practice as a lawyer. So that was a landmark point where this point was argued and discussed in the court of law. And it was clarified, or that judgment has now, in fact, been incorporated here also, that human body, even though you say that, let us say I'm a film star, for me, my looks, my body is very important and I'm spending huge amount on its maintenance. Or let us say in case of any professional like we chartered accountants, lawyers, our mind, our heart, all these body organs are very critical because they help us perform our work in a more effective manner. But we cannot claim any deduction on their maintenance. We cannot claim any operative expenses where you have underwent some surgery for any of these organs because these are not treated as asset in the first place. So if they are not asset, Section 32 depreciation not allowed, Section 30 and 31 repair maintenance expenses are also not allowed. Expression part includes parts of plant. So if vehicle is included, then the parts of vehicles will also be included. Similarly, the term building, which is not a plant building, is a separate asset, will includes roads, bridges, wells, tube wells. So whatever is constructed within the periphery of the building, that will be considered as building. Then your asset should be used for the purpose of business. Again, we will have that section 38 point that if the asset is partly used for business, then part depreciation can be claimed, part cannot be claimed. That will come later. Now coming to a very interesting point, this you will understand much better when you do the practical part, but today we'll cover it in theory. Now, when you are doing accounting depreciation, you will recall in accounts, we have seen that if asset is purchased on a particular date, which is generally mid of the year somewhere, let us say 15th of September, what you do is you start claiming depreciation from 15 to 31st March. If some asset is purchased on 1st Jan, you will start computing depreciation from 1st Jan to 31st March. So in accounts, you do depreciation on a day basis. So especially for assets which are purchased, you compute depreciation from the date till 31st March. Now, as compared to this, the difference in income tax depreciation is in income tax depreciation, firstly, the date of purchase is not important. So in accounts, you start from date of purchase generally. In income tax, date of purchase is not important. They say date of put to use. This date is important. Second, they have said that we will not go by this day-wise approach. Instead, the year in which the asset is purchased and put to use. So in the year of purchase, if the asset is put to use for less than 180 days, then we will give you half depreciation in that year. So this is interesting. In accounts, you go day wise from the date of purchase. In income tax, we don't see the date of purchase. We say there are date of put to use. Put to use means where the asset is installed, fitted, and ready for production. That is the date of put to use. And if in the year of purchase, if the date of put to use is such that up to 31st March, less than 180 days are left, then in that year, you take half depreciation. So in income tax, we will never do day-wise depreciation. So in the year of purchase, either you will take full depreciation if the period of put to use is 180 days or more. But if the period of put to use in the year of purchase is less than 180 days, you will take half. 50% means not the rate of depreciation is not 50%. Rate may be 10, 15, 20, 25, 40, whatever. You will take half of that rate. So read this 50% as half, not the rate of depreciation. Next point, which I just mentioned few minutes back, where the asset is not used only for business, but it is used for other purpose as well. Again, as per 38, you will take proportionate depreciation. Same point was in rent and other expenses also above. Same thing continues for depreciation. Now, interestingly, when we say asset should be used for business, the use may be active use or passive use. Now, this is interesting. What is active use? Active use means where you are using the asset for running your business activity. Passive means where you yourself are not running the business or using it in your business, but either it is used by somebody else or it is just kept ready for use. Like many times we have these standby machines. So in different industries where production cannot be stopped because of its criticality, you always have an additional equipment which is not used, but it is kept ready that in case my main equipment has some failure, has some accident, has some problem, and it stops functioning, I can immediately switch to the other machine. That machine may not be actively used, but even if it is kept ready for use, that is also eligible. So use need not means it should be actually used. It may be even kept ready for use, which is called as passive use. That is fine. Next, obviously, you should be owner of the asset. So for claiming depreciation, only when you are owner, you can claim depreciation. If you're not owner, you cannot claim depreciation. In this, there is one important exception. That is where, now this point will be covered later in an explanation, but since we are here in this point, I'm covering that point here. So let us say where the land is on lease. So you're not the owner of land, but the building you have constructed by yourself. So even though the land is on lease, but since you have constructed the building, so you become owner of the building, you can take depreciation. Second, building is also on lease. So no question of depreciation because you're not owner. But let us say in that building, you have constructed one additional floor, which is again a capital expense. So you can claim depreciation for this. So these are exceptions to the rule where you may not be the actual owner. See, this is what is given in explanation one. So you may hold the asset on lease, but if on that asset, if you have incurred any construction, then to the extent of that structure which you have constructed, you are owner and you can claim depreciation of that structure. Now coming to something relating to computation. Now, interestingly, for the purpose of computing depreciation, income tax has a very special method or approach called as the block method. What is this block method? This is what we are going to study in the next class. For the time being, you can say it is your WDV method, but it is not like how we do in accounts, but it is a WDV method. However, we have also the straight line method, which you have studied in accounts. Now, this straight line method and WDV are very different. We will study the practical WDV method in the next class. Importantly, this straight line method is only allowed to power generating companies. So you are an entity, maybe public or private, which is engaged in generating electricity. Only you are given option. Interestingly, this is also not compulsory. This is an option, but this option is only given to power generating entities. Okay. So only to power generating entities, Rule 5A says that they can take depreciation as a percentage of actual cost, which is nothing but the SLM method. But for all other entities other than power generating entity, there is only one method, which is block. Now for power generation, they have option between both these methods. This option has to be exercised by them in the first year before filing their returns. Whatever they exercise, this will be final and cannot be changed thereafter. So power generating units are also allowed this option only once. So in the first year after their creation, when they are starting their business, in the first year when they are filing returns, they have to select the option and that will be full and final. The second method is the block method, which is also the WDV method. We'll study this in detail in the practical part. This is given in Rule 5. So 5 bracket 1 is the SLM method, which is the option given only to power units. And for all businesses, the method is block of assets method, which is the WDV method. Now, besides the above depreciation, which is your regular depreciation, you have something called as additional depreciation. So regular depreciation, which is allowed to all, additional depreciation is allowed only to few people subject to some conditions. Now, we are going to study something about this additional depreciation. But first thing which I would like to clarify, which we saw even today in the format, that this method, or not method, sorry, this additional depreciation deduction will be allowed only if you are out of the new regime. That is, if you are opting to pay tax in the old regime, only to them additional is allowed. So regular is allowed to all. Additional, which is the extra depreciation, is allowed only to assessee opting out of the new scheme. Now, additional depreciation is allowed only to manufacturers, only on new plant and machinery. So even for manufacturers on land, building, or any other assets like furniture, etc., additional depreciation is not allowed. Further, if they have purchased second-hand plant and machinery, additional depreciation is not allowed to them even on second-hand plant and machinery. So first, it is allowed only to manufacturers. Second, the plant and machinery should be new. Third, it should be used for production activity. Now you'll say, sir, plant and machinery will be used for production only. No, there are machines which may be used for other purposes, like even your vehicles are machines. They come in plant and machinery category only because they are machines, but they are not eligible for additional depreciation. Similarly, any asset, like let us say you have a cooling water cooler, that is also a machine. You have ACs installed in the office. You have so many machines installed in the office. Computers is also a machine, not eligible for additional depreciation. But where the same cooling, where the same AC, where the same computer is used for production, let us say your production creates a lot of heat. So for maintaining the temperature, you require cooling plants, or you have installed some high power coolers or ACs. Those ACs are eligible for additional depreciation. Similarly, where your production is automated using computer and software, that computer and software is also eligible for additional. So that is what is the other point. Next, your asset regular depreciation rate should not be 100. Now you'll find that some assets are such whose regular depreciation rate itself is 100. Now for them, additional is not allowed. Why? Because you can claim entire 100% in regular depreciation only. I cannot give you additional depreciation above the cost. So for these assets, additional depreciation is not allowed. So these are the four broad conditions subject to which additional will be allowed. You should be manufacturer. Asset should be a new plant and machinery. It should be used in production, and it should not be having a rate of 100% in the regular depreciation. Now, if all these conditions are satisfied, then besides your regular depreciation, which everybody is getting, you will get extra depreciation called as additional depreciation at the rate of 20% of the cost. Most important, this is allowed only once in first year of asset. So in the first year where the asset is put to use, only once you can claim additional depreciation. So regular depreciation is allowed every year on the WDV. Additional depreciation will be allowed for an asset only once, that is in the first year of that asset. The rate is 20% of actual cost. Now, what if the asset is put to use in the first year for less than 180 days? Then what will happen? As we saw above, you can claim only half depreciation. So regular is allowed half. So even additional is allowed half. Half means you will claim depreciation at the rate of 10%. Now, interestingly, here you will be allowed depreciation in the first year as well as the second year. So first year you took half. So the balance 10% you will take in the second year. So this is the only case where additional depreciation will be allowed in the second year also, because you have taken half, that is 10% in the first year, balance 10% you claim in the second year. But this is not possible thereafter. And every asset, every new plant and machinery, only once you will take this additional depreciation. Mustafa says, sir, if we just use for 182 days, yes. So 182 days is more than 180 days. No? So 100% will be allowed. Sir, in 115 BSc, they give tax planning exemption till 12 lakhs with rebate, but they didn't give most of the deduction surcharge till 25%. So both regimes are at their way best. Mustafa Beda, see, understand this. Government wants the new regime only. But immediately, if I remove all the benefits, it will create a chaos. People will protest. So slowly and steadily, government is phasing out the old scheme. Right now, they are in the phase where they are giving option since past few years. After 2, 3 years, you'll find that old is totally removed. So that is why till this transition phase is going on, you are at your choice to decide which scheme you want. See, Kuldeep, equipment directly generating output is not the condition. Using in production and equipment generating output are two different things. Like cooling plant, no output is generated. But if the cooling plant is necessary for maintaining the temperature of the production area, it is still used in production and additional is allowed. Aditya, how you find out half depreciation? So half means what? Whatever is your rate of depreciation, take half. Like your regular rate of depreciation is 1,515. So take 7.5. 7.5 multiplied by the cost of new asset. Similarly, your additional depreciation rate is 20%. So take half, that is 10% multiplied by the cost of new asset. This is how you'll compute half. Now, where additional depreciation is not allowed, where the plant machinery was already used, or where it is not used in production, like it is used in office premises or residential accommodation, guest houses, or if it is office appliances or vehicles. Further, where it is not allowed, where the whole of the cost is allowed as deduction, that is 100% deduction is allowed. Now, there is a clarification that even if you are engaged in printing and publishing, you can claim additional depreciation because printing publishing is also clarified to be a manufacturing process. So people who are engaged in printing and publishing, for them also additional depreciation is allowed on their printing machines. Further, additional depreciation is allowed only when you are opting out of the default scheme. That is a new scheme. Now there is something called as terminal depreciation. Now regular, additional, all these are depreciation when the asset is being used. Terminal depreciation is a depreciation in the last year. Now let me tell you what will happen in the year of sale. Now there are two methods, block of asset method and SLM. Now we know SLM is only for power units. Block of asset method. In the year of sale, no deduction for depreciation. So for block of asset method, which is applicable to everyone, In the year of sale of asset, you will get no deduction for depreciation. However, if you are following SLM method, you will get your last deduction of depreciation in the year of sale, which is called as terminal depreciation. Now, how much will be this depreciation? It is simply the difference between your WDV and the sale value. So let us say WDV in your books is 110. You sold this asset in this year for 95. So this balance 110 minus 95, that is 1515 rupees, is the last depreciation that you can claim. So only for SLM assets, the last depreciation, that is why it is called as terminal. Terminal means the end. So now the asset is sold. Please remember, I repeat, it is only for SLM, that is for power units, that they can claim this. For others who are following block of assets, in the year of sale of asset, there is no deduction of depreciation. So these are the rates of depreciation. You need not learn them. I repeat, you need not learn them. They would be given in the exam. So now this remaining part is relating to the practical aspect of depreciation, which we will study in the next class when we do depreciation. Hmm. Just give me a minute, please. Now, what is this carry forward and set off? Now, interestingly, you have a topic called as carry forward and set off of losses, which you study in the next part after all the heads are computed. Now, when you are computing any head of income, there is a possibility that there could be a loss in any particular head. Now, pay attention to this example. So, let us say this is your P&L. Your sales is 100. Now, you have different expenses, purchases, wages, rent, rates, insurance, everything, which is 112. And you have depreciation, which is 15. In this scenario, you will say that I have a net loss of 27. So accounts will say that we have a net loss of 27. Income tax is fine. But for you, whatever is the net loss of 27, for us, the net loss is in parts. We say this 27 is attributable to what? It is attributable to depreciation up to 15 and 12 for other expenses. So we say, instead of saying that my total net loss is 27, in income tax, we will say my unabsorbed depreciation is 15 and my other business loss, that is loss because of other expenses, is 12. So for the purpose of set off, you will study in the chapter of set off that your business loss is divided into loss because of depreciation, which is called as unabsorbed depreciation, and loss because of other expenses, which is called as other business loss. Now, why this segregation is required? Because the provision for setting off this loss, and if the loss cannot be set off in the current year because there is no profit, then carry forwarding it to future year. The provisions are covered under different sections. Like for this, you will study section 72 for carry forward, but for unabsorbed depreciation, the section is 32 bracket 2. So there are different provisions for carry forward and set off of different losses. So this is what is important. So all this point relating to set off, I'm not explaining now because this will be part of your carry forward and set off chapter. Next, this part we already studied, where there is any asset which is not used only for the purpose of business. So you have section 38, which says that whatever expenses are relating to this asset, like rent, insurance, depreciation, all these expenses would be proportionated, and only the proportionate part which is relating to the use of business will only be allowed. Balance will not be allowed. Now, again, in the year of sale, block of assets, and for SLM. Now, in the year of sale, we saw above there was a concept for SLM, that is for power units, that there will be last depreciation. Now, interestingly, there is another concept of balancing charge. Now, what is this? Now, see, in the year of sale, there are two possibilities. First possibility is that you will have terminal depreciation, that is last depreciation, or you will have balancing charge, which is your income. Now you'll say, sir, what is this? For this, you have to understand that in the year of sale, what will happen? One, your WDV is greater than the sale price. So there will be some type of a loss on sale, what we call in accounts loss on sale. Income tax is call it as terminal depreciation. If vice versa happens, sale price is greater than WDV. So in accounts, you say it is profit on sale. Income tax says call it balancing charge. So this both concepts are only for SLM asset. It is not applicable for block of asset. So for block of asset, we have altogether different treatment. There is no such separate or special treatment. But for power units who are following the SLM method in the last year, that is in the year in which the power undertaking has sold its assets, if the WDV is greater and sale price is smaller, which we call as loss on sale of asset in accounts, it will be called as terminal depreciation in PGBP. If vice versa happens, WDV is more, sale price is less, WDV is less and sale price is more. In accounts, you say it is profit on sale of asset. We say it is balancing charge. It means it is your income from business and profession. So this is interesting. Now, where any asset is used for scientific research, we are going to study this in detail in 35. Important to note is scientific research gives you deduction under a separate section of scientific research, which is explained here in detail. Now let us understand this. So now the depreciation part is over. Now we are on another section, another very important section of PGBP head, scientific research. Now in scientific research, there are two possibilities. One is you are not doing the research, you are making payment to outside approved associations, college, laboratories, or you are doing research yourself. Now, important, if you are doing research yourself, you may incur capital expenses for doing the research, like establishing the laboratory, bringing some equipments for research, or you may incur revenue expenses for research, like all the research material that you'll bring or the salary you'll pay to your research professionals. Now, interestingly, both these deductions are covered in section 35. Importantly, where you are not doing the research is done by some outside person, the research may or may not be related to business. Still, we will allow. But important, it is allowed only under old scheme. So under new scheme, this deduction is not allowed. When you're doing in-house research, the research should compulsorily relate to business. And this is allowed under both schemes, under new also and old also. So in-house research related to business allowed under both schemes, old and new. And in case payment is made to outsider, it may be related to business, may not be related to business, but it will be allowed only in the old scheme, not in the new scheme. Now see, where you are making payment to outsider, the only rule for outsider is the outside association should be an approved or notified association. You will get full deduction, 100% of whatever expenses is paid, but only under the old scheme. If you are doing in-house research, condition is the research should be related to business compulsorily. And here, the expenses may be revenue or capital, both are allowed 100%. And this is allowed under both the schemes, new as well as old. So this is what is explained here. Importantly, even capital expenses are allowed. Very, very important. But whenever we say capital, you should always remember there is no deduction for land. So neither under depreciation nor under scientific, you cannot claim deduction for land. Similarly, even preliminary scientific research is allowed. So where expenditure on scientific research was incurred even before commencement of your business, it will be allowed subject to conditions. Now, since you are claiming full capital expenses deduction, again, you cannot claim deduction under depreciation. So logical, either you claim the entire cost of that asset as deduction or you claim depreciation. Now here, since we are allowing the whole cost, the depreciation cannot be allowed. Next important point, unabsorbed. Same like unabsorbed depreciation. If your capital expenditure on scientific research remains unabsorbed, it will be carried forward and it will be set off in a special manner given under 35(4). So same like unabsorbed depreciation, the unabsorbed capital expenditure on scientific research will also be carried forward and set off in a special manner. Now, interestingly, what will happen where you sell the asset? Which asset? Which you had purchased for scientific research. Now, this is interesting. Let us say I had purchased the asset for cost of rupees 100 and this cost was allowed as deduction under 35 as capital expenditure on scientific research. So let us say all this happened in the financial year 22-23. Now in the present year 25-26, I decide to sell the asset. Why? Because now I no more need the asset for research. Now there are two possibilities. First possibility is I sell the asset for rupees 75, which is below this 100, or second, I sell it for 140. Now, interestingly, what is the interesting part? This rupees 75, these all are sale prices, will be considered as PGBP income. And here, if it is sold for 140, out of 140 rupees, 100 will be considered as PGBP and balance will go to capital gains. Now, what is the logic? The logic is simple. You had claimed deduction in the past of 100 rupees for this same asset. Now, when this asset is sold, till the extent of this 100, whatever you will receive will be PGBP only. Why? Because I debited 100 in the past Now on sale, when you are recovering the amount, to the extent of 100, whatever will be recovered, I have to nullify the debit. So I had allowed deduction of 100. Up to that extent, whatever is recovered, it is my income under 41. Recall the logic of 41. Deduction allowed in past, now reimbursed or recovered. That will be treated as PGP income. But if I receive something extra, so this 40 I'm receiving over and above the amount which I had claimed as deduction earlier. This 40 cannot be treated as PGBP. So where asset representing capital expenditure is sold without using it for any other purpose, the provisions of 41(3) are attracted, which says that the sale proceeds, right, to the extent it does not exceed the amount of deduction, will be treated as PGBP. But if there is any excess, the excess will not be treated as PGBP. It will go to capital gains chapter. The next part is where you are making payment to outside approved association. So the details of this is given, and all these points, the common point is you should not be in the new scheme. For all outside payments, you should not be in the new scheme. Only then deduction is allowed. So this is all about scientific research section. Now this section, students, if you remember, we had studied this in the previous class to some part. Now we'll complete this section in this current session. Now, you are engaged in some specified businesses for which 35 AD has given the names. What are these specified businesses? You are running a cold chain, that is a cold storage for some specified products, mainly agriculture, or you are running a normal warehouse for agricultural produce, or you have set up a cross-country natural gas or crude oil pipeline network for transportation. Next, you are running a hotel which is of 2-star or above category. You are running a hospital which has 100 or more beds. You are in housing projects which is relating to slum redevelopment, or again housing project which is under affordable housing scheme of government, or you are engaged in manufacture of fertilizer, or operating inland container depot, container freight station relating to import export, or you are in production of honey or wax through beekeeping, or you are having warehouse for sugar, or you are having a pipeline for transporting iron ore, or you are engaged in operating a semiconductor wafer manufacturing unit, or you are engaged in developing, maintaining, operating any new infrastructure facility. So these are the specified businesses. We studied this list in the previous class as well. Now, for all these businesses, what does Section 3580 says? On similar lines of scientific research, same lines, it says that entire capital expenditure you take as deduction. Now, when I say entire capital expenditure is deduction, so obviously no depreciation, because for same amount, I cannot give two different deductions. Otherwise, it will be unfair. So I give you 100% deduction for these capital expenses upfront. So the moment you spend on building, on furniture, on machinery, I'll give you deduction. But I will not give you deduction for land or goodwill, for any other financial assets like share, debentures, etc. I will not give you deduction. So for them, except land, except goodwill, except all these financial instruments, for all other assets, all other capital expenditure, you claim deduction immediately. But for these, no deduction allowed under 35 AD. Further, the restriction of payment of 10,000 in a day is applicable here also. So here, for these capital expenses, when you are making payment, please follow this rule that you should make payment only by way of account pay check or account pay draft, or using the notified electronic medium. If you make payment exceeding 10,000 in a day of any of these capital expenses, and it is not paid by this particular method, the amount will be disallowed. You will not get deduction for that amount. Now, most important, this entire section is applicable, that is deduction under 35 AD will be available only if you are opting out of the new scheme. So in order to get this deduction, you should be in the old regime. You should have opted out of the new regime. So same like additional depreciation, this is also not allowed for new regime. Next, where you have incurred these expenses even before commencement of business, that is preliminary. So capital expenses incurred even before commencement of your operations are also allowed. Obviously, when in the year when you start your business. Now, what are the conditions to be fulfilled to be eligible for 35 AD? First is you should be in the old scheme. That is obvious. Second, your business should be a new business and it should not be formed by merely splitting up of existing business. So in short, you should have started a new business, not taken over anybody else's business. Second, the plant and machinery which you are using here in this business should not be used earlier. Means it should be a new plant and machinery. However, relaxation of up to 20% of old plant and machinery is allowed, or where plant and machinery is brought from outside India, even if it was used outside India, it will be allowed. Now, important, whatever businesses we studied under 35 AD, that businesses may also have similar benefits under some other section. Like you have a section under 10AA for SEZ. So your business is in a special notified area called as SEZ. Or you have a deduction under chapter 6A heading C. Now see students, all these are in different chapters, but just for the time being, keep in mind one simple point. So where for the same business, I'm giving you deduction under some other provision of the act, you cannot claim double deduction. So if you are claiming deduction under this section, you cannot claim deduction under the other sections. Obviously, double deduction cannot be allowed. So for same business, double benefit cannot be taken. So no deduction allowable under the Act in respect of expenditure for which deduction is allowed under this. Now, for all the above businesses, some dates are given. You may not learn these dates, not required, but why these dates are given? Because when this section started, it had only one or two businesses. Later on, the government found this a very effective way. So they started adding other businesses. So that is why some date is given. Now, interestingly, if this business incurs a loss, again, in the set of chapter you study that for the purpose of setting off the loss of 35 AD business, that is the specified business, there are some specific restrictions. First, most important restriction is that the loss that you are having under 35 AD for the specified business can be set off only against specified business, not against any other business. So 35 AD loss set off only against 35 AD income. So either you should have another business which is falling in 35 AD in the same year, or in this year you simply carry forward this loss. And in the next year, when your business will show a profit, set it off against that. But important rule, 35 AD business loss cannot be set off against any other income. Now, students, all these practical sums, now when you will solve, you will understand them. I remember in the initial first or second lecture, somebody was having this small grudge. Sir, I am not able to solve the sums. But at that time, I had already clarified that I had not asked you to solve these questions because these sections were yet to be studied in detail. Depreciation is yet to be studied in detail. So except depreciation, you can now practice any of these topic sums. Now, in this same 35 AD business, what will happen if you are selling your asset? So if the asset is demolished, discarded, destroyed, or sold, what will happen? Interestingly, whenever you will sell this asset on which you had claimed deduction under 35AD, whatever amount you will receive, the amount will be taxed under Section 28. This was the last point of Section 28 list today, which I had left because I said I'll do it with 35AD. So simply, the point is very simple. If the asset was claimed as deduction under 35AD business at the time of purchase, at the time of sale, at the time of sale, the entire sale price will be treated as PGBP income under Section 28. So on purchase, the cost is deduction, and on sale, the sale price is PGBP income. So simple. Purchase, you have shown on the P&L debit side, sale you show on the P&L credit side. In short, forget that this is a capital asset. So for 35AD business, the assets will not go to capital gain. It will be treated here only. Second interesting point, you have not sold the asset, but you have shifted the asset from 35AD business to any other business. So let us say I'm having two separate businesses. I had purchased a bus, which is a capital asset, to be used in 35AD business. That is for transporting employees of 35AD business. What is my 35AD business? Let us say it is that honeybee business. So I'm manufacturing honey. So for this bus, the cost was rupees 50 lakhs, and I had claimed the entire amount as deduction under 35AD immediately, because 35AD allows me to take deduction immediately. However, after 4 years, now I shifted this bus into another business. Now, this is a regular business. What is this business? I'm a manufacturer of biscuits also. So I manufacture biscuits. Now I shift this bus from here to here to be used for transporting employees of this business. Now, what does the law says? If the asset which you had used for the specified business is shifted within 8 years to any other business, what will happen? Now, in this year, when you shift this, what will happen? So I have two P&Ls. One is of 35AD business and another is P&L of my regular business, which is biscuit manufacturing. Now, in this 35AD business, this amount of 50 lakhs will be shown as PGBP income, assuming that you have sold. Now, actually, you have not sold, but it is like this, you are selling from this business to another business. Just assume this. So since I have sold, following the above point, which we studied here, that whenever you sell, you treat it as business income. So here, I'm shifting from one business to another. So just in your mind, you assume that you are selling from this to another. So since you are selling in your 35AD business, you will treat this entire 50 lakhs, which was the cost, as your PGBP income. Now, what will happen? In your other business, it will become a capital asset. But interestingly, here you have to claim depreciation on this capital asset. Now, an interesting part is this asset is already used for 4 years. Now, in depreciation, the cost will be what? The cost will be the WDV after 4 years. Now, interestingly, you had used this asset for 4 years in the old business. What you will do is you will compute 4 years depreciation. So on this 50 lakhs, you will compute depreciation for 4 years. Now, that amount may come to XYZ amount. Let us say, for simplicity, just for simplicity, I am assuming that that amount is coming to rupees 20 lakhs. What is this 20 lakhs? Depreciation for 4 years. Interestingly, In my 35AD business, there will be two effects. First, I have shown the sale of entire 50 lakhs asset, but then since I had used it for 4 years, I debit it by 4 years depreciation. So in effect, net 30 lakhs is shown as income in your 35AD business. But if you are finding that 30 lakhs understanding difficult, so I've shown it as assume that entire asset is sold, but since you have used it for 4 years, debit the 4 years depreciation. So it is easy to understand. Similarly, in this regular business, this net amount, that is 30 lakhs, will be shown as cost of this asset. And you can claim depreciation from the 5th year onwards in this regular business of this 30 lakhs. So let us say here the depreciation will come as 4.5 lakhs. So first effect is in 35AD business, 50 lakhs, the cost will be treated as sale price plus 4 years depreciation will be debited. And this net 30 lakhs will be treated as cost in your new business. And thereafter, new business means your regular business. And thereafter, on this 30 lakhs, you will start claiming depreciation in your regular business, because regular business, you claim depreciation of capital assets under section 32. So in regular business, you start claiming depreciation. And in 35AD, you nullify the effect of that asset on both sides, entire cost on the credit side and the depreciation on the debit side. Students, I hope you have understood this part of 35AD. So this will happen when you are selling or removing the asset from 35AD business. If you are selling to outsider, entire sale price, whatever is the sale price, is your PGBP income. If you are internally shifting to another business, then whatever was the cost, that is income, but the depreciation also has to be adjusted, debited. And this net amount will be shown as the cost in the books of regular business, and depreciation on that will be taken. So students, these are some very important, interesting, slightly tricky provisions of PGBP. Now in the next class, we'll continue from this section, that is 35D onwards, and we'll complete the remaining provisions. So that's it all for today, students. Thank you. Thank you very much. I'm sure all these things would have added value. Yes, tax is very vast, complicated as well, but we try to regularize it with regular efforts, with consistent studies. You will be able to understand, and over a period, you will also be able to master. But that will require time, that will require consistent practice. Thank you. Thank you very much. Kindly study, read module, mark your queries, and we will take up. Thank you. Good day. Yes, sir. Thank you very much. Good day, sir. Thank you. Bye.